Hi everyone, this is Financial Goals. In this video, we will learn the difference between investing and trading. At the end of this video, you will be able to answer a question. Which is better, investing or trading? Before we start, please don't forget to click a like and subscribe button as I will be uploading more financial education videos in the future. Thank you. Let's begin. Terms investing and trading are often used interchangeably. However, there are key differences between the two financial strategies. The goal of investing is generally to build wealth over the medium to long term. By contrast, the goal of trading is to generate profits in the short term. Let's take a look at the basics of investing and trading and explain how the two financial strategies differ. What is investing? Investing is a longer-term buy-and-hold strategy. Investors will often hold assets for years with the aim of generating substantial profits from rising asset prices and any income generated from the assets over time. An investor's exact time horizon will depend on their financial objectives. For example, someone who is investing for retirement may have a time horizon of 20 years or longer. Someone who is investing to build up a house deposit, on the other hand, may have a time horizon of 5 years. Next, a fundamental principle of investing is that the higher the potential return of an investment, the higher the risk of that investment. This is known as the risk-return trade-off. Risk refers to the chance that an investment's actual returns will differ from its expected returns. What about trading? Compared to investing, trading is a more active, short-term focused strategy. Traders tend to hold assets for a much shorter period of time than investors, often buying and selling securities within weeks, days, or even hours, with the aim of profiting from short-term price movements. Whereas investors mainly seek to profit from rising asset prices, traders look to profit from both rising and falling prices. Instead of focusing on long-term growth prospects like investors do, traders focus on which direction the price is likely to head in next and try to profit from that price movement. Compared to investing, trading generally requires more time commitment. While an investor can buy a stock or fund and forget about it, a trader needs to be constantly monitoring market developments. Another difference between investors and traders is the way they research their markets and look for opportunities. Typically, investors focus on fundamental analysis. This type of analysis involves looking at all available information in relation to an asset in order to decide whether to buy or sell that asset. For example, in the case of a stock, an investor might look at the company's recent revenue and profit growth, its balance sheet, the threat of competitors, and the economic backdrop in order to determine whether the stock is worth buying. Traders, on the other hand, tend to focus more on technical analysis. In this type of analysis, traders examine price charts and analyze trends, patterns, and indicators in an effort to predict an asset's future price movements. The idea behind technical analysis is that historical price movements can be used to predict future price movements. 3 popular technical analysis strategies include: first, trend trading. This strategy aims to generate profits by analyzing an asset's price trend. Once a trader has identified the trend, it may be possible to profit from it by trading in the same direction as the trend. Next, support and resistance trading. This strategy aims to generate profits by identifying an asset's support and resistance levels. Support is the level on the chart where the asset's price finds it difficult to fall below. Resistance is the level where the asset's price finds it difficult to go above. Once these areas have been identified, it may be possible to profit by placing trades at the area where the asset's price is likely to reverse. And lastly, breakout trading. This strategy aims to generate profits by identifying assets that have broken through established support or resistance levels. Breakouts can be strong signals, especially when confirmed by other technical analysis indicators. Now that you have an understanding of the difference between investing and trading, which is better, investing or trading? The answer is, it depends. Both investing and trading have their advantages and disadvantages. One strategy is not better than the other. Both have proven to be successful ways of profiting from the world's financial markets. Ultimately, which strategy is suited to you will depend on a variety of factors including 1. Your financial objectives. 2. Your risk tolerance, and 3. The amount of time you're willing to dedicate towards research and monitoring your holdings. That's all for today. Thanks for watching.